This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi and welcome to AJ Bell Money and Markets, the podcast that helps you make sense of what's going on with your money and investments. I'm Charlene Young, and joining me this week is Laura Suter.
Hi there. On today's episode, we'll be covering the latest on Tesla and Netflix earnings. Plus, we'll be keeping you updated on the latest political noise from the US and how that's impacting markets, particularly looking at the rising gold price. We're also going to be talking about rising savings rates, including an update on NS&I's new British savings bond. And Charlene has been digging into premium bonds on what your chances of actually winning look like.
We've also got Tom Sieber from Shares Magazine here to look at whether fund managers with direct industry experience might offer a different kind of edge. And Dan Coatsworth sits down with Peter Fitzgerald from Aviva Investors to talk about how investors are responding to rising tariffs and trade uncertainty. And we've got our resident pensions expert Rachel Vahey on to talk about the tax situation when you're taking money out from your pension.
So plenty to cover there. Let's start, as we always do, with what's been happening in the markets. So Tom Sieber is joining us. The first obvious area, I think, is the latest on the Trump situation. So do you want to just give us a quick update on what's happening there, how markets are reacting, with the caveat, obviously, that this could change at any moment, probably even while we're recording this?
Absolutely. Yeah. Nice and calmly, as you'd expect. But in all seriousness, it's been a bit of a roller coaster. President Trump has been critical of the Federal Reserve Chair Jerome Powell in the past, but he ramped up the rhetoric over Easter, and it created some fear in the markets about the independence of the US Federal Reserve and that might be under some threat. So on Easter Monday, with Wall Street, unlike European markets, open for business, there was some pretty heavy selling, and the dollar and US Treasuries also experienced a pretty significant sell-off. So there was quite a flight from US assets. And, you know, I guess that's because if there is sort of perceived political influence over the Fed and its decision-making, that has implications for inflation and for US credibility with the markets. Now, you know, we, like you say, Laura, we're speaking Wednesday lunchtime. Things could change, but it looks as if Trump has perhaps realised he might have gone a bit too far, or I don't know. Some of his advisors perhaps have had a quiet word, and some of his subsequent comments have been more measured. He's talked about having no intention of firing Powell, and that's helped to restore a measure of calm. The Treasury Secretary Scott Bessent has also been talking about a de-escalation in the kind of tariff standoff with China. So Wall Street has pretty much recovered the losses it saw on Monday, but obviously it's still solidly lower than it was at the start of the year.
Perhaps unsurprisingly, we've seen the gold price shoot up in response to market turmoil over the past few weeks. So what's really been leading to that, and what's that gold price looking like now?
Yeah, so I think one of the key things is, you know, often when the markets are turbulent, people reach for assets like the dollar or US Treasuries as a safe haven. But because a source of a lot of the kind of recent market uncertainty has been the US, you know, that's not been a kind of obvious port in a storm, and gold has potentially benefited from that. And I think it's worth putting in a bit of context, really. So gold hit $3,500 per ounce recently, and that is genuinely quite astonishing. You know, the first time gold was above $2,000 was in August 2020 during the pandemic, and then it took another 4 years to hit the 2,500 mark. By March this year, so a little bit more than 6 months later, it had gone over 3,000, and then it's taken less than 6 weeks to go from 3,000 to 3,500. You know, we talked briefly just there about how, you know, Trump has walked back his Powell comments a bit, and that has led to a bit of a retrenchment in gold as we're speaking. But I think, you know, gold enthusiasts will still be eyeing the possibility of the precious metal hitting $4,000 an ounce. You know, that's I guess the next level to chalk off. So I think that, you know, people who believe in gold will still be looking at that, given it's not necessarily the only safe haven, but certainly its kind of safe haven credentials are less compromised than perhaps some other obvious ports in a storm during market turbulence.
Yeah, and we've talked about Commander-in-Chief Donald Trump, so no surprise that Chief Doge Elon Musk also gets mentioned this week. Musk Watch, as Laith likes to call it. As we mentioned, we're recording Wednesday lunchtime afternoon, and yesterday night UK time we had Tesla reporting. After a period where protests have marked the company's reputation, what did the results tell us, Tom, and how were investors responding?
Yeah, so I think it's interesting because there's two sides to it, really. So, I mean, the results were bad and actually worse than estimates. But I think because the mood music around Tesla has been so negative for some time, so, you mentioned the protests. Also, there's been evidence of slumping sales. And also because in a conference call that followed the results, Musk was talking about dialing back his involvement in government and perhaps bringing a bit more focus onto Tesla. The shares have actually had a bit of a bounce. I mean, the US markets have also recovered a bit. So, there's an element of that at play. But it's certainly been received kind of reasonably well, given how poor the results were. I mean, whether that is sustainable, whether or not that will continue, remains to be seen, I guess. The numbers were bad. So profit was down 71% for the first 3 months of the year. Revenue was down 9%. And I think whether or not it can recover depends on how lasting the sort of damage to the Tesla brand proves to be. So, I guess, without wanting to generalize too much, historically, the typical customer for an electric vehicle, you'd think would have political leanings that are kind of at odds with where Musk has positioned himself. So it's whether or not, that is enough to sort of permanently damage the Tesla brand, I guess. And also, I think it's worth saying that the company could probably do with a bit of product innovation in the here and now. So, Musk is often talking about, self-driving cars and robotics and different areas like that and the potential there. But that's only likely to be realized years into the future, if at all. So I think it's not just about the kind of brand, but also, the products behind that brand and whether or not they can, bring some innovation to that.
It's been a bit of a quieter week for, company results and earnings because we've had the long Easter weekend. But we did have Netflix report just before the bank holiday weekend. And the numbers looked solid, but probably you'd say not spectacular, Tom.
Yeah, although I think, the market was probably quite happy with something solid given the current backdrop. Just being solid is probably quite attractive to people. And, it even got people talking about Netflix having some, defensive qualities that, it might be an area that you could ride out some of the tariff uncertainty. So, revenue was higher, margins were pretty steady, and the outlook was reasonably robust. The company's seeing some decent growth in some new markets, like India, for example. And, the launch of the ad-supported tier continues to prove a success. And it means that growth isn't just reliant on Netflix continually adding more subscribers. Obviously, they can bring in advertising revenue. They can, personalize advertising because they know quite a lot about their customers. And I think, part of it is also that after a period where Netflix was quite lax or loose in its spending on content. I mean, it's still spending a lot of money on content. It's due to spend $18 billion in 2025 alone, but there's a sense that the approach is a bit less scattergun. They're looking to spend in areas where they're likely to see, a return in terms of new subscribers or getting more eyeballs. What's interesting as well, this wasn't, a feature of the earnings necessarily, but there was reporting in the Wall Street Journal last week that the company has ambitions to get to a $1 trillion valuation, which is a bit more than double what it is today by 2030, and has also internally set some pretty ambitious growth targets. So it will be worth keeping an eye on Netflix to see if it can go from being solid to a bit more spectacular in future quarters.
Thanks, Tom. I feel like, we're getting maximum value out of you this week with these market updates. I'm also not letting you go just yet,
No.
because I know this week you've been looking at something I find really interesting, actually. So you've taken a look at whether fund managers who've actually worked in the industries they invest in bring something different to the table. So these managers will often understand the operational side of businesses in a way that, maybe traditional analysts might not. So what did you find out? And does this kind of real life experience shine through?
Yeah, so I mean, there's some evidence certainly that fund managers, who have this hands-on experience do have a bit of an edge, and I guess it does make sense intuitively. You can see why it might be an advantage. I mean, you can read the whole article in the latest edition of Shares, but one of the managers we spoke to was a guy called Marek Posebsenski. I'm hopefully pronouncing that right. Who is a co-manager of International Biotechnology Trust, and he worked for a Swedish pharmaceutical company quite early in his career. And one of his big takeaways, one of the things he shared with us, was that particularly with biotech ventures, it's so important that you have strong management, and I guess that would apply in other areas of what as well. But even to the point that you could have a bad project with good management and they would be able to make the most out of it, but even the very best projects could be ruined by bad management. So that was one of the takeaways.
I think it just really points to the fact that it's worth knowing who's behind the fund and what kind of experience they have when it comes to researching funds and looking at the fund managers. So it's not just about where they went to university or business school, is it?
Exactly. So another contributor to the article was Mark Smith, who co-manages the W.S. Amati Strategic Metals Fund. And this guy is a trained geologist, and he has experience of gold exploration in Africa. And he made the observation that in that industry, management teams will often look for a get-out clause if, the project they're working on isn't performing as it should be, or costs have overrun, and we'll sort of say, these were unforeseen issues. But he feels that they're able to say, well, no, actually, you could have foreseen this for X, Y, and Z reasons. And, basically saying to these companies, look, you're not dealing with a generalist investor here. We've genuinely worked in the industry, and we're able to sort of pick up on things that other people might not. So, yeah, I think it's an interesting one, definitely.
Thanks, Tom. Right, bit of a pivot. Let's talk premium bonds. So we know they're hugely popular in the UK. So the thrill of a chance of a prize is clearly a big pull. But are they actually worth it? We submitted a Freedom of Information request to NS&I, and I've been taking a look at it to get kind of a clearer picture about what's going on. So of the 22.7 million current premium bond holders, a staggering 14.5 million have never won a prize. So that's almost 2/3 of those. Now, there were over 5 million prizes in the 12 months between March 24 and February this year. And within that winning group, over 80% of people actually won multiple times. So there's a potential positive that there's been a shift recently in terms of the prizes that are won. So most winners are now receiving prizes of £50 or £100 instead of the lowest £25 on offer. And that's compared to previous years. But the vast majority of those winning prizes in that 12 months I mentioned were still worth £100 or less. So another really interesting point, alongside the fact that, a lot of people win multiple times, is that the average holding for these prize winners is just shy of £24,000. And that's far higher than the average £5,406 holding across all premium bond customers. So I don't want to be the fun police, but the fact that £127 billion is held in premium bonds, that's, coming from NS&I themselves, that means potentially a huge amount of money is just that they're making no return, whilst there are other options out there, obviously, for cash. So we've seen, again this week, the markets flush with cash accounts, including ISAs that are also tax-free. And they're paying rates higher than the premium bond estimated prize fund rate. Of course, that isn't a guarantee, but it's an indication, that you can use for comparison purposes sometimes. And it just means, premium bond holders might benefit from shopping around if they're looking to make their cash work harder.
Yeah, I think it's a good reminder that kind of safety, that perceived safety of NS&I and of premium bonds, needs to be weighed up against the return that you're going to get on that money. It's tricky for savers out there at the moment because we know lots of people are facing a tax bill for their savings interest. We know that there's been a lot of ups and downs in the saving market. We had a long period a few years ago where you earn very little on your savings. And I think that means that some people have got a little bit disengaged with the savings market. But what good news there is that savings rates have been rising. So if we stick with NS&I for now, it recently updated the rates on its British savings bonds. So it's increased the rates on offer there. These are fixed term accounts. So 1, 2, 3 or 5 years, different versions of the bonds, whether you want the income or whether you want growth. But decent rates on offer there. As always, with NS&I, you can get higher rates from other providers in the market. So the way that NS&I works is that they will almost never be market leading because that would disrupt the savings market. And because they're a government-backed provider, that's not their role. But if you want that kind of safety of a government-backed provider and you want these fixed-term bonds, then the rates are better now than they have been previously. But more broadly, we're seeing quite a lot of choice increase in the savings market. So Moneyfacts put out a report this week showing that the number of providers in the market is hitting a record high, and the number of savings accounts out there that are available is also on the rise, particularly when it comes to cash ISAs. So they calculated that there was a new record number of accounts on offer with 611 different types of cash ISA available at different rates from different providers, which seems an overwhelming amount. But fortunately, there are comparison sites out there that can help you whittle down what type of account you want, whether you want easy access or fixed rate, whether you want a high street provider, one that you can bank online or in branch, for example, and then list by the rates to see what you want. Around this time of year, we do see a lot of competition in the ISA market, in the cash ISA market. It's the time of year where lots of people rushed to fill their ISAs before the end of the tax year, and then might continue that momentum into the new tax year where they then put more money into their cash ISA. And because of that, you've just got more providers vying for that business, which pushes rates up. So it might feel a little strange that savings rates are rising at the time when we're also talking about there being more interest rate cuts from the Bank of England this year, where we're seeing mortgage rates drop. It feels like a bit of an odd environment, but largely that is being driven by that competition in the ISA market. And we've also seen the fixed rate savings market, a bit more competition pick up there. But I think the main message is there's lots of choice out there at the moment. And if your account has been sitting there for a year or longer, then it's a really good opportunity to check and see if you're getting the best rate available. Quite often those providers, as we know, sneakily will cut that interest rate after a year if it's an easy access option. So it's definitely a good reminder to check in and see if you're getting a good rate. Equally, if you know that you are facing a bill for the tax on your savings interest, then it's a really good opportunity to look at your ISA and look at whether you want to use a cash ISA for your savings to protect that money from tax.
Yeah, definitely. And just a word on comparison sites as well. Obviously, we want people to shop around, but something we have noticed as well is that they don't always include investment ISA providers that offer interest on cash in stocks and shares ISAs as well. So it's kind of, yes, there's 611, I think you mentioned, providers, but there actually might be more out there paying higher rates of interest than a bank might on a cash ISA. So yes, a good shout out there to our very own Doddle by AJ Bell. But I will move on. We have an interview for you. We've dispatched Dan once again. So recent volatility on the markets will have driven many people to kind of review their investment portfolios and see if they actually are properly diversified in terms of asset classes and geography. An expert in this area is Peter Fitzgerald, who is Chief Investment Officer of Macro Discretionary at Aviva Investors. So as I mentioned, we've dispatched Dan. He's recently caught up with Peter to talk about the impact of tariffs on portfolio decisions, the role of bonds in a portfolio, and whether investors are now turning their back on US equities. Let's hear what Peter had to say.
So I'm pleased to be joined by Peter Fitzgerald, who's the Chief Investment Officer for Macro Discretionary at Aviva Investors. So Peter, thanks ever so much for coming on to the podcast.
More than welcome.
I think I'd like to start by asking about Trump's tariffs? Because clearly this has caused investors to think hard about their asset allocation for their portfolio. I know in these sort of situations, people will talk about make sure you're properly diversified across different asset classes and geographies. I mean, it does feel like gold perhaps is the only asset at the moment that's offering sort of proper support to a portfolio. What do you think are investors' options at the moment in the face of tariffs?
Yeah. So first of all, I think the challenge you have is the starting point for most investors, which is some form of global equity benchmark, is probably inappropriate, and it's probably this shall we say episode has really brought the attention home to the fact that just because you have a global equity portfolio does not mean it's diversified, where you've got 70% of the assets in one country, which is the US, and actually 20% of your entire portfolio is invested in just 7 stocks. So I think what it's going to do firstly is have people just reflect on, do I even have the right benchmark or starting point for my diversification? Because if your benchmark is not diversified, and it's a global benchmark, that's a challenge. And then you're right. I think gold has done well through this particular episode, but it's not the only asset class that has provided some stability to portfolios. So if you look at things like European banks are up 25% this year. You have the FTSE All Share, which has actually weathered the storm reasonably well. And then you have some of your more traditional sectors within equities, but more of a value and a defensive framework, such as food and beverages and tobacco for those investors that can invest in that. These have actually provided reasonable returns, and of course, then there's dividends in the future to kick in. So I don't think it's all doom and gloom. I think yes, gold is useful, and I think it should form part of most people's portfolios. And I know that's and I'm not a gold bug by any stretch of the imagination, but I do think it's got a place in portfolios. But there are other things that people can do.
What about the role of a bond, perhaps in a multi-asset portfolio? I think do they really offer protection, particularly when whether there's tariffs or there aren't tariffs?
Yeah. So I do think bonds they do have a role to play in a portfolio, but they will only work in one specific circumstance. And that circumstance is if you hit a full stop in the global economy due to tariffs. So you just end up with supply chains getting into difficulty, you end up with employment falling, and that will ultimately force central banks to probably respond by slashing interest rates aggressively. Now, I'm not saying they need to go back to negative rates or back to zero, but if they were to take rates back to 1.5%, 2%, for example, that's a scenario in which I think you could see some of those bonds provide you with some balance in the portfolio. However, if the slowdown or the recession is driven more by an inflation fear, then these bonds are not going to provide you any protection. And actually, as you've seen more recently, even over the last couple of months, as equities have fallen by relatively large amounts, bonds have actually sold off pretty much at the same time. So they haven't provided you with any protection. So I think as long as you're clear about what it is you're trying to do with the bonds in your portfolio, that's okay. And then there's another argument when it comes to bonds, is the performance of short-dated bonds, sort of 2-year and 5-year bonds, have actually performed much better than 10-year and 30-year bonds. So it really does depend on what part of the curve you've been invested in also.
I mean, you mentioned about inflation and what central banks might do. I think that tariffs sort of threaten to drive the rate of inflation higher. And I think in that situation, normally you would expect interest rates to go up as central banks try to fight inflation. But obviously, we've got the prospect of worst case scenario of recession caused by these tariffs, and in which case the recession would mean central banks cut interest rates. I mean, how do you think, particularly say in the US, what will the Federal Reserve potentially do if it's seeing higher inflation, weaker economic growth? I think people are sort of slightly confused about what might happen next.
Yeah, and most people have to grapple with these two conflicting things. Its tariffs are inflationary, but they could cause a recession. A recession in general will lead to lower prices, lower demand, and therefore, on a medium-term basis, you will have lower inflation. So there's two aspects to this. One, the Federal Reserve has a dual mandate. So one is price stability, which is the inflation that you spoke about, and the second one is full employment. So our view is they will look through the immediate inflation shock provided by any tariffs, focus very much on that employment number. And if you were to see the employment situation becoming more challenged and unemployment rising, then I think despite the fact that inflation would be momentarily above their target, they will cut rates, and they will cut them relatively aggressively and relatively quickly.
Yeah. I mean, I think a lot of people at the moment are, they're looking at the US and wondering if, that place that's been a source of very strong returns over the last 10, 15 years for investors is perhaps not as appealing as it was year, 2 years ago. I think that, could we see a situation where people start to aggressively sell down exposure to the US? I mean, could that actually cause the US stock market to really lag the rest of the world if we see widespread selling? Or do you think actually all it would take is a little bit more selling beyond what we've already got for people to go, actually, I made loads of money on this area before. I'm going to potentially look for opportunities here to buy more rather than completely get out?
Yeah. So I think, first of all, you have to go back quite a while to find a period where US equities underperformed global equities ex the US. One of the examples I use is if you've got 10 years investment experience, you started investing or managing money in 2015, right? That's nothing. If you have 15 years experience, which is a reasonable amount of experience, you started managing money or investing in 2010. So you didn't even experience financial crisis. If you've got 20 years experience, you started in 2005, you didn't experience a 3-year bear market. So you actually need to find people with 25 years plus experience of either investing or managing portfolios to have a period in history, and I'm going back recent history, where US equities did underperform. And US equities underperformed from 2002 all the way to 2007 for a 5-year period. And they materially lagged global equities. And that's not just Europe, they lagged UK and they lagged emerging markets as well. It's not to say they lost a significant amount of money, but they can easily flatline or do very little while other areas play catch up for what has been an exceptional period of returns for US equities. So I would, my advice and my position on this is, I think we certainly need to be open to a period where US assets lag those of the rest of the world. The globe is overinvested in US assets in terms of investors outside the US are overinvested in the US, and investors in the US are completely underinvested in any assets outside of the US. So I don't think it would take a huge amount to see a period whereby that market rebalances. And if I look at it today, the MSCI global equity benchmark is 71% invested in the US. That's not a balanced or diversified benchmark. And our view is that I think the probability is you will see some realignment of that over time.
I mean, what do you think would be the type of weighting that the US could, or perhaps longer term, could sit at? I mean, are we talking sort of 50% or even less?
I think it should be even less than 50%. I mean, only a few years ago it was 50%. If you go back 20 years, it was in the low 40s. So I just think investors have become accustomed to the sole driver of global equity returns is the US. And even if you delve deeper, a lot of those returns have accumulated to a small number of large tech companies. I managed money during the previous tech bubble of 2000, 2001, and 2002, and therefore quite attuned to the possibility that while AI and tech may well change our lives, it doesn't mean that you as an investor are going to make a substantial amount of money by allocating capital to those businesses.
I mean, I guess if investors dial down their US exposure, where do you expect that money to be reallocated?
Yeah, so I think you can look at the European equity market, for example, where you're seeing for the first time in a generation real fiscal stimulus. And love him or loathe him, what Trump has done is he's forced Europe to wake up to the fact that they do actually have to look after themselves from a defense perspective. They do have to spend some money. And not many people expected Germany to adjust its debt brake and to come up with the fiscal stimulus in the size that they did. So Europe is one place that you could see some of that capital being reallocated. The UK is another where you have relatively attractive valuations and attractive dividend yields. Japan is another market where, again, you have corporate governance that has improved and you have valuations that are not as stretched as other parts of the world. And our view is that within the whole world of trade wars and tariffs, that Trump will probably be relatively nice to Japan. He needs them for security and other reasons. So you are more likely to see some sort of deal there. So I think Japanese equities are attractive. The one area that I think tactically rather than strategically could be of interest are some of the more emerging markets in China. But I think they are more challenged because that's the epicenter, if you like, of the focus of the US. So really it's pretty much all of the global markets outside of emerging markets and the US.
Well, Peter Fitzgerald from Aviva Investors, thank you very much for coming on the podcast. It's been brilliant to have you on.
Yeah, no problem. It's been a pleasure.
That was Peter Fitzgerald, CIO at Aviva Investors. And finally on the podcast this week, we turn to Pensions Corner. We know that a big appeal of pensions for some people is the ability to take some of their money tax-free at retirement. But as is sometimes the case with pensions, the rules can get a bit tricky. So our pensions guru, Rachel Vahey, is going to explain the tax situation when making withdrawals from your pension. So first up, Rachel, how much of your pension can you take tax-free? I'm hoping that's a simple answer, is it?
I hope so as well. You can take a mix of tax-free lump sums and taxed income payments from your pension. And you can start doing this from age 55, although this age changes to 57 from 2028. But the most tax-free cash you can take from your pension is 25% of the pension pot. Now, if you choose to do this, then you've got to do something else with the other 75%. It's got to go somewhere. And when you take that money out, it's going to be taxed in the same way as any other income is taxed, say earnings from employment or self-employment. So what can you do with this 75%? Well, you can take it out as just one lump sum, but that may mean paying an awful lot of tax in one particular tax year. Or you can swap it for a regular income that's going to last you for the whole of your life. And this is an annuity. This is what we call an annuity. Or you can keep it within the pension pot, which is drawdown, and then you can just take a taxed income from that drawdown pot whenever you want to.
And in terms of kind of the benefits of taking that full tax-free lump sum, that 25%, versus spreading out tax-free withdrawals over a period of time, what's the kind of difference there, Rachel?
Well, as you say, Charlene, you don't actually have to take all of your tax-free cash as a one all at once, though there are other ways to do it. One of the things you can look at is just to take a chunk of your pension pot at a time, and that chunk is going to be split. So 25% of it's tax-free, and the other 75% of it's going to be taxed like income. And if you don't need all your tax-free cash, then the good news is that you can just take these chunks or these ad hoc lump sums whenever you need. Now, I know you hate jargon, Laura, and I'm really sorry, but I'm going to sneak this one in here, and I hope you're going to forgive me. Because these chunks or ad hoc lump sums do have a technical name, and this comes up from time to time. So I think it's probably better that we're clear with people and let them know what other providers might call them. So they're called uncrystallized funds, pensions, lump sums, or UF pluses, which is really one of the most horrible pieces of jargon.
So jargony.
I am so sorry. I am so sorry. But instead of thinking about the jargon, let's just focus on what they can do for you. So it means that you can only take a little bit of your tax-free cash and just take the tax-free cash you need. Now, that could be a lot more tax efficient because it means that each year you can take a payment that's partly taxed and partly tax-free, and that's going to reduce the amount of tax you pay in any particular year. And another really good advantage of taking your money in this particular way is that the pension pot that you haven't touched, it can stay invested and it can continue to grow. So that means you could end up with a bigger pension pot overall and a bigger amount of tax-free cash for later. So these ad hoc lump sums, these chunks of money, they can be really useful to help you manage your tax bills.
I think that's really important to break it down, because I think lots of people think about the fact that they can take that 25% of their pension entirely tax-free, and they think they just want to get their hands on that bit straight away. So it's really important, and I will allow you that small amount of jargon because you're right, it was essential. Now, you talked earlier about the fact that you can take 25% of your pension pot tax-free, but is there a limit on the total amount that you can take tax-free?
Yes, there is a limit. It's called the lump sum allowance, and the limit is £268,275, which isn't exactly an easy number to get.
No,
to get your teeth around it. It doesn't really easily slip off the tongue, does it? That one. But that's the overall limit from all your tax-free lump sums from all your different types of pension. So every time you take a tax-free lump sum, then it's knocked off that overall total. So you just keep a tally going.
Thank you, Rachel. That was Pensions Corner. And that's all we've got time for this week. Thank you all for listening. You can follow Money and Markets wherever you get your podcasts. And if you find this episode useful, please feel free to leave us a review or share it with someone else who might benefit. We'll be back next week. See you then.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.